Well, hello, everyone. Good morning. I'm Sandy Davis, Senior Advisor here at BPC. Appreciate the kind shout-outs from Bill and from Doug. I am so pleased to be here today to welcome you guys also to the event we're having here. And we're very pleased to be able to co-sponsor this, do this jointly with Results for America, this event today. I mean, we're especially pleased to have the two authors of the paper that you've heard referenced so far. I will tell you, we don't have printed copies of it here available to us today. It has been posted on the it's a Tax Policy Center website, right? Yes. And so that is available online for you to look at on your smartphones if you wish, but certainly when you get a chance. You know, this discussion today is really kind of refreshing. Believe it or not, how can a discussion about tax expenditures be refreshing? But it's refreshing in that it's, as Doug mentioned, it's a focus, different focus than what you get usually in most of these tax policy discussions. We're not talking about macroeconomic effects of tax policy or winners or losers, but we're talking about whether tax expenditures should actually do the things, as Doug mentioned, that they were set out to do. And how do we measure that? And shouldn't we evaluate them for that purpose? This is something that we at BPC believe strongly in. As Bill mentioned, we have our initiative on evidence-based policymaking led by Nick Hart. And we believe across the board, tax policy and spending policy, that programs should be evaluated for their effectiveness, for their outcomes, and this information should feed into the policy process. Determine how they should be changed, what new ones should be put in place, and just generally should have a seat at the table of all policy discussions. We're so lucky to be joined again by the two authors here. I want to introduce them briefly, and I'm going to step aside. Gene Sterling. My friend Gene has had many hats in his career. He's currently the Institute Fellow and Richard B. Fisher Chair at the Urban Institute. He has served as Deputy Assistant Director or Secretary at the Department of Treasury for Tax Analysis, I think in the Reagan administration. Is that right, Gene?
Several, including Reagan.
Okay. Been president of the National Tax Association, co-founder and co-director of Urban Brookings Tax Policy Center. In addition, Gene is a prolific author and has been, I would call him a warrior for calling our attention to the long-term fiscal policies that we have in place and their basic on sustainability, and think creatively about how we can deal with that going forward. His colleague here, Ben Harris, co-author on the report. Ben is chief economist at Results for America, visiting associate professor at Northwestern University, has been an adjunct at the University of Maryland as well in Georgetown, and formerly was a senior economist with the House Budget Committee when Chairman Spratt, I believe, was chairman of the House Budget Committee. And I got to work with Ben in that capacity when I was at the Congressional Budget Office. So, without further ado, I'm going to turn it over to these gentlemen to present the paper, take some questions from you all, and then we'll go forward from there. Gentlemen, the floor is yours.
Thanks, Sandy. I appreciate the warm introduction. Let me just start with a few words of thanks. Thanks to Doug for the keynote. It's a true honor having you here. I honestly had no idea what you were going to say, so I was sort of pleased by the positive endorsement. It made your remarks even better. And a huge thank you to BPC for co-hosting this along with Results for America. I think that both organizations are clearly laser-focused on evidence-based policymaking. So my hope is that this joint event today is the start of a long relationship, given our mutually shared goals. I'm just going to make three quick points and then turn it over to Gene, sort of about the paper and the context for the paper. The first point is that the motivation for this paper grew out of what I see as sort of a growing movement, and I don't think that's too strong of a word, a growing movement around evidence-based policy. So Results for America was founded a few years ago with the sole purpose of driving evidence-based policymaking. If you go to our website, you see that it says, our mission is to make investing in what works the new normal, so that when policymakers make decisions, they start by seeking the best evidence and best data available, and then use what they find to get better results. Then here at BPC, you've got a new initiative around evidence-based policymaking, which is led by Nick Hart. BPC put out a terrific paper, I guess, a few weeks ago or a few months ago on 19 different strategies that Congress can use to inject policy into better inject evidence into policymaking. And as Sandy said, this is really refreshing. I mean, this is a bipartisan idea. It's sort of nice to be talking about this now, about how we can make government work better without the partisan politics that is such a distraction. And just if you want another example about how the movement between evidence-based policy making is continuing, we had a few years ago in 2006, there was a bipartisan bill that came out of Congress that created a bipartisan commission, which put out a bipartisan report. So you notice a common theme here. It's just bipartisanship throughout. So if you're looking for better government, if you're looking for bipartisanship, I think evidence-based policymaking is a terrific place to look. The second point I'll make is that this interest in better use of evidence or evidence-based policymaking has yet to translate into evaluations around tax expenditures. And that was one of the motivations for the paper. It was saying, look, we have all of these frameworks in place on the discretionary side, and to a certain extent, frameworks on the mandatory side that evaluate whether or not taxpayer dollars are going to what works. Let's extend that so there's more equal treatment to tax expenditures. And I assume everyone in this room is familiar with the concept of tax expenditures. It's a notion of spending through the tax code. Economists seem to sort of agree with this idea. People who aren't economists tend to find it somewhat off, and I've had plenty of discussions where people disagree with the notion of tax expenditures, but if you're an economist, you probably buy in to the notion that, look, if you get a $1,500 tax cut for having a mortgage and paying interest, it doesn't really matter if you get that subsidy on your tax return or if someone sends you a $1,500 check. That's all semantics. You're still getting a $1,500 subsidy. It really doesn't matter, and that should be evaluated the same whether or not it's being provided through the discretionary side, the mandatory side, or through the tax code. It's just all semantics, the difference. We have a $1.5 trillion tax expenditure budget. That's a ton of money. We should be making sure that's going to what works and that these programs are achieving their intended goals. But as Doug mentioned, we're not really sure what their intended goals always are. So to take one example, the mortgage interest deduction. The mortgage interest deduction was never designed to subsidize homeownership. It just was that it's just been in the tax code ever since 1913. It used to be you could deduct other types of consumer interest. As that fell off, we have this one big deduction, which costs around $60 billion a year. And we say, okay, it's for home ownership, but the truth is, it's always been there. So I think Doug's exactly right in saying it's not always clear what these tax expenditures are designed to do in the first place. And the third point I'll make is that, as we said, tax expenditure evaluation just pales in comparison to other types of evaluation on other types of spending. So just take discretionary spending as an example. Discretionary spending, sort of the first layer of oversight is the budget process, which includes agencies going through an exhaustive process where they submit their justifications. It's compiled by OMB, which has another level of oversight. Then the administration compiles its budget and submits that to Congress. Congress considers the budget, then has hearings through the appropriations process, and then requires 60 votes in the Senate and a majority in the House to actually pass. That's just to get the first dollar out the door. Then when that dollar has gone out the door, you've got GAO providing audits. You've got OMB, who has a central mission in preventing waste, fraud, and abuse. You've got inspector generals at the major agencies. Then you've got, at some of the agencies, you've got chief evaluation officers, like the one at Department of Labor, which right now is conducting 30 evaluations into its programs to see whether or not that works. In comparison, on tax expenditures, you've got JCT doing its great work, but it's not really charged with, it's not a central mission. Maybe Tom Barthold will have thoughts on this later, but it doesn't seem to me like it's a central mission exhaustively evaluating all of the various tax expenditures. So you have this asymmetry between these different types of spending, and that's a real problem, particularly given the magnitude of the tax expenditure budget. So with that, I'll turn it over to Gene, who will talk about how we can actually fix this problem.
Well, thank you. It was an honor to work with Ben on this paper, as well as our co-author, Caleb Quickenbush. And it's also an honor to work with the Bipartisan Policy group here in terms of sponsoring it and with Results for America. And of course, the Tax Policy Center that was engaged as well. A really good group of people all the way around. When Ben approached me on this, he said basically, in this town, we've gotten to the point now where we all agree on the facts. It's time to get around to getting good analysis. All right. We'll worry about alternative analysis somewhat later. But I want to make clear that although we're talking about the need for greater and better analysis of tax expenditures, we're not necessarily saying even that the appropriations process in aggregate is somehow or another better than the tax policy process. They both have advantages and disadvantages. But we are talking to the extent to which we get the types of analysis and evaluation we need in tax policy. And just a couple examples from history, and this goes way back, but when I was the coordinator, ended up almost by accident to be coordinator of the tax policy process in '84, leading the Tax Reform Act of '86, I discovered at the Treasury we had actually literally never done a comprehensive look through the tax code, which is sort of the approach we took at that time. We just never had the time, and this is in the Office of Tax Policy, which is probably the largest group of tax policy people, at least economists anywhere, a little larger maybe than even the Joint Committee on Taxation. Another example from my history, which is just a minor example, for years, because I work a little bit on charitable contributions, I discovered for 25 years we couldn't get the Statistics of Income Division even to report on aggregate amount of in-kind charitable contributions, which are now about 30 or 40%, just the basic data. So there are all these lapses in terms of what we do and what we do in terms of analysis of taxes. And of course, the main reason, which is going to come up over and over again in our paper, is actually the lack of resources. Tom knows that I was somewhat chagrined by the fact that in the complexity analysis, which is a requirement by Congress for the Joint Committee and the Treasury and the IRS to do a complexity analysis of a tax bill as it went along, we just really couldn't get much done, and even had statements there such as, it will not result in, this was for the 20% extra deduction for small business, will not result in an increase in disputes with the IRS, nor any regulatory guidance will be necessary. So you get things like this that just in a speedy process, without the resources and without a formal analytic process in place to make it happen, you're just going to get either lapses or you're going to get actual errors. So we struggled then, however, with what and how and where you might put such analysis. It's one thing to say we should need more tax expenditure analysis, but how and where do you do it? And we basically came up with two conclusions. One, no matter where you put it, you had to give additional resources. And B, you do have to think about ways of trying to ensure you can actually integrate it into the process, because if it's in the process, there will be demand for the use of and implementation, use of some of these resources and implementation of some of the advice. So I'm going to quickly go through this list, which you can read for yourself. And in many ways, we're just trying to tee up the ideas. We're hopefully that this paper is basically a way of actually generating more thoughts on how one might do this, and we don't want to claim that we've had any one answer. And like Doug, we actually would think about putting analysis several places. We weren't even thinking just one office in the executive branch or one in the congressional branch. For instance, as you go through the paper, you'll see we talk about the advantages GAO tends to have, particularly on things that you might think of as more audit and administration, and also just size of staff. So there's some things that should be put there, but in terms of policy, probably you are going to have to be more directed to groups like the Joint Committee on Taxation. So what was our list? Well, our list was, we went through evaluations within the executive branch, evaluations by the nonpartisan congressional agencies, JCT, CBO, GAO. We talked about external evaluators. I'm not going to go through that very much because our conclusion was that on occasion you might use some external evaluators, but you have all of the same issues hiring and using them that you do with other issues. And something I do want to spend 1 or 2 minutes on, which is how can we set processes in motion that will actually make use of this. In terms of evaluations by the executive branch, Office of Tax Policy is probably the best equipped in the sense that it has the most public finance expertise. OMB has an advantage in terms of anything, particularly that cuts across agencies. So if we're dealing with something like the low-income housing tax credit, you might want OMB to try to require some integrated analysis between Treasury and Housing and Urban Development. We even talked about how you might try to empower the IGs to get a little more into this area. I guess technically they could get into some of these issues, but typically do not. Within the congressional branch, obviously the JCT has got the primary responsibility in the areas of tax, although CBO probably puts out more studies. of particular issues. And so one wants to think about how to balance the resources there. And as I mentioned a minute ago, GAO has advantages in terms of size and in terms of examining often the efficiency and administrability of a variety of provisions. So let me turn finally just this issue about what types of processes you might set in motion. Some processes, by their very nature, lead to consideration. Now, when we talk about appropriations, we typically think of annual appropriations, but we don't necessarily argue for. In fact, I think the experience with extenders in the tax bill, we would argue against annual analysis of every tax expenditure. We don't think that that's necessarily going to be appropriate, but you can do things on a periodic basis. You could set up a system to periodically examine tax expenditures. You do have to face the issue Doug raised of what's going to be on the list, but even if the list is only 2/3 of what's there are a lot of these expenditures that are really never analyzed in any depth, and one could require them to be analyzed on a periodic basis. We could also put them into the budget process itself more formally. We don't favor indiscriminate, say, across-the-board caps on tax expenditures. We don't think they work any better than caps on direct spending. But one could think about some forms of sunsetting, particularly with respect to those tax expenditures that grow automatically. There's no reason we should automatically have more and more spending, for instance, through the home mortgage interest deduction every year as people buy larger houses. We haven't even done an analysis of how well the particular provisions work. So one can think about ways of sunsetting some of these, although again, I think one has to almost go through one by one to figure out how that would work. We mentioned the fact that one could set up some joint commissions. We didn't recommend a permanent joint commission. We don't think that works for the most part, but one could occasionally put up a joint commission, particularly where you're dealing with an area that cuts across agencies through tax and direct spending agents to deal with stuff that we often don't deal with. And a final one that is one of my favorites and one that I've been pushing for a long time. I do think IRS could be reorganized to do a better job with respect to the way it collects and analyzes data. I don't think IRS is the place to put the policy, so I'm not arguing that they be separated from the policy. They do have input into the policy office, such as the Office of Tax Policy, and they also often provide a lot of input, a lot of data to the Joint Committee and the other congressional agencies. However, I do think they have too little staff devoted to particular provisions that they have to implement. And one can think about IRS as either being way understaffed, or one can think about them as being way overemployed. There's two ways to deal with the extraordinary demands on the IRS, and one is, of course, you continually add to their resources. The other is you actually have them do a better job of revealing what they can administer, what they can't administer, as a way of having an input into the policy process. Even the way that they do evaluations on compliance, for instance, they'll often come up with statistics on how much over-reporting there is or how much under-reporting there is. They don't give you a statistic on where they don't know. So let's take something like, I'll go back to my in-kind charitable contributions. Anybody here get little slips when they go to Salvation Army or give away their clothes? You can fill out the slip for yourself. To think that IRS in any way can administer that is silly. But they don't provide us data that said, okay, here's Ben, he reported $10,000 for charitable deductions. We can confirm pretty well on audit, $3,000. $1,000 he really probably cheated on, but the other $6,000, we have no idea at all whether this is accurate or not. We need that data to be able to determine whether this stuff can be administered. And one could set up IRS with a modest share of its resources. Remember, at times they've approached 100,000 in staff. If you had 1% of their resources, and that'd probably be excessive, devoted to analyzing particular tax expenditures, making sure there were data on it, data on compliance, data on how much it's used, data on other issues like that, that could be 1,000 people or a couple hundred. So, as I say, we've make several suggestions along the process lines. Our hope is the succeeding panel, as well as you, come up with other alternatives. The bottom line is more resources need to be put into tax expenditure analysis, and we need to think formally about what processes need to be put in place so that those resources will be demanded and used. Thank you. I guess we have 10 minutes for questions from the audience. I'll sit down over here.
We should have someone with light.
We're back to.
Please identify yourself.
Thank you. Larry Checo, Checo Communications. Doug talked about congressional intent, and Gene talked about lack of resources. Can we draw a line between the dots of the tax cuts and Congress's intent? I mean, there's a correlation between tax expenditures and revenue. And if you're telling us that there's not enough revenue to do tax policy analysis, and Congress is cutting the budget, what are we supposed to think?
So I agree with you. And I think Doug spoke to this very well. We have a huge budget problem today. And of course, every tax expenditure increase, although this bill did cut back on a number of tax expenditures, it also increased the number, but every tax expenditure requires higher rates to even raise whatever the given level of revenue. I will say, and this is speaking how analysis actually does make a difference, however good or bad you think this bill was. If you look at what was in this bill, for instance, compared to what was in the campaign, it was maybe, Tom might have the numbers better. We did an analysis at the Tax Policy Center as well. It's maybe had about 30% of the revenue cost of what originally came out of the campaign. And a lot of that was due to analysis. Now, it wasn't analysis of each particular tax expenditure, but it was analysis of the cost of a lot of these items. And many of them were paired through analysis. So analysis does make a difference, even if it's only succeeding in what Jim Wexler often talks about, which is who's a former Joint Committee leader, who basically talked about if you want to be happy with policy and you're working in policy, you have to be happy getting a C+ or a C- once in a while. But if you're expecting to get an A all the time, you're going to be very disappointed in your career.
You know, I mean, I think that we did have this major tax reform. It created two new tax expenditures. One was the Opportunity Zone, which cost, I think, about $7 billion over 5 years. And then, as Doug mentioned, the 20% carve-out for pass-throughs. You know, I think for the Opportunity Zones, it's pretty clear what it was designed to achieve, which is to help reverse the unequal development of various places around the country. So some disadvantaged communities, we're trying to get more money into that. It would be great to evaluate that and find out if that works. It's not a ton of money relative to the other tax cuts, but this is something we've been trying to do for a long time. This is the time to evaluate it when it's starting right now, but we're not. On the pass-through, as Doug said, like, I'm not really sure why that was designed the way it was, and maybe Tom knows because he was central to the process. But we're spending $200 billion over the next 5 years on this, and it would be great with a new tax expenditure to have an explicit statement for why this $200 billion was spent the way it was, and then an infrastructure in place to see if it's working or not. Because if it's, you know, whatever the reason, I'm sure the Congress had a good reason for putting it in there, but it'd be nice to know what it is, and it'd be nice to evaluate it, and we're not doing either.
Carl Polzer, I'm a policy analyst. Did you guys consider encouraging in these new institutions a particular type of analysis? And I have two in mind. One is distributional analysis, and the other is whether a tax-favored policy would create relative cost inflation. On the first matter, there's a lot of concern that certain types of tax-favored benefits enhance inequality. For example, pensions, perhaps housing. And on the relative cost inflation, you have health insurance, and whether, you know, it encourages more insurance and, you know, more cost inflation than services that don't get tax favored, that have to operate in a free market. Perhaps housing there too. Thanks.
I'm not sure I know fully what your second part of your question was, but on distributional analysis, I actually think we do a modestly decent job between the Joint Committee on Taxation and Treasury and Tax Policy Center and others. We don't probably do it often enough. Again, I think IRS could do a better job, but I'm a great fan of the statistics of income and adequately giving them the resources. So I'm not sure on the distributional issue that we lack resources as much as we do on sort of the efficiency, meeting of intent, cost benefit analysis, types of analysis that one really needs and sometimes gets through the direct expenditure agencies.
Yeah, so I mean, I agree with Gene on distributional analysis. Between the various think tanks and what we have at the public sector resources, I have a pretty good idea about the distributional effects of the tax cut, and TPC and Tax Foundation can disagree. We don't have a very good idea about if these are working or not. Just take, for one example, take retirement saving incentives. $200 billion a year on retirement saving incentives. This is a laudable goal, right? Everyone should be saving for retirement, or most people. It's really important to the stability of households. People are living longer. It's really important. But we have this very bizarre system of subsidizing retirement where it's basically based on often a multi-decade deferral where you get a write-off in one year and then you pay taxes later on. And these $200 billion is based on the concept that you're probably going to be paying a lower tax rate in retirement. Maybe that 20, 30, 40-year deferral isn't the best way to subsidize retirement saving. If you look at some of the studies that have come out of academia, so for example, there's a really high-quality study that Raj Chetty did based on data in Denmark. Denmark has much better data than us, by the way. But they found that for every $100 spent in subsidizing retirement saving, you got about a $1 boost in actual saving. That's not very efficient. And I'm not saying we shouldn't subsidize retirement saving. We should. But the current system, at least if you look at the studies, you can put together a collection of studies which show about a 1% increase in net saving for every dollar spent on retirement. So we can do a lot better. So, to answer your question, I think we're doing okay on distributional analysis. We're doing really poorly on finding whether or not these actual tax expenditures work. Any other questions? Yes.
I'm Brian Tumulty from the Bond Buyer.
Just a second.
I'm Brian Tumulty from the Bond Bar. How would you analyze the termination of advance refundings for state and local governments, the benefit of doing that when you hear from state and local governments there is no benefit, and how would this work under your system?
So everything I've learned from advance refunding, I've forgotten. And there was a Hamilton Project paper and I used to be the policy director for the Hamilton Project at Brookings. Andrew Ng wrote about it. And so here's the problem, which is that I am not familiar with any public sector research on your question. There are at least one or two, probably more, academic economists who've written on it. But there's no connection between an academic paper, like the one I was sort of referencing, and the process. And that's a problem. And I've had 3 different public sector jobs that all involve tax, and I never had to learn about the question you're asking. And that's really the problem. So I don't have great information on what you're asking, and that's kind of why we wrote the paper in the first place. That's great. Okay, so turn over the panel now? Yep. Great, thank you.